Okay, so when you're selling your home, one of the biggest financial puzzles you have to solve is your mortgage, right? Do you take that great rate you have with you, or do you just start fresh? Let's break down the options so you can figure out the smartest path for your move.
This is the big dilemma for so many homeowners right now. You found a home you love, but that fantastic low-interest mortgage you locked in a few years back, man, the thought of giving that up can make you feel completely stuck. But the good news is, you've got options.
So here's what we're going to cover. First, we'll look at this low-rate dilemma. Then we'll dive into your two main options, porting and breaking. We're going to demystify that scary-sounding prepayment penalty, and then we'll put it all together so you can plan your next financial move with total confidence.
A lot of sellers feel, financially trapped. You're excited about finding a new place, but you're also kind of anchored to this incredibly valuable low-rate mortgage from a totally different economic time. So let's figure out how to solve that tension.
It really just boils down to two main paths, and each one has its own set of costs and benefits. So let's start with the one that lets you keep that amazing rate you've got. So this first option is called porting. Think of it as the strategy where you literally pick up your existing mortgage and you just take it with you to your new house.
So what does that actually mean? Well, porting lets you transfer your original term, your principal balance, and, most importantly, that awesome low interest rate over to your new home. Now, it sounds perfect, but as always, the devil is in the details.
The easiest way to think about it is like your cell phone plan. When you move to a new apartment, you don't cancel your whole plan and get a new number, right? You just call your provider and give them your new address. Porting is kind of like that. You're keeping the same contract, you're just changing the property it's attached to.
But, and this is absolutely crucial, porting is not automatic. Just because your mortgage says it's portable doesn't mean the lender has to let you do it. They are going to make you fully requalify. That means they're pulling your credit again, verifying all your current income, and making sure they approve of the new property. If anything's changed in your financial life, you could get denied.
Okay, but what if you're buying a more expensive house? That's a super common scenario. Well, you can often do what's called a port and increase. Your lender ports the balance you already have at its great low rate, they give you the extra money you need at today's rate, and then they create a single blended rate for your new payment. So you still get a huge benefit from your old rate on most of the loan.
All right, so that's porting. Now let's look at the other side of the coin, the option to just break your mortgage completely. This is all about getting a totally fresh start.
When you break your mortgage, you're basically choosing to end your contract early. Now this means you'll have to pay a prepayment penalty, and we'll get into that in a second. But once you do, you're free. You are no longer tied to your current lender at all. I know what you're thinking. Why on earth would anyone choose to pay a big penalty? It's all about freedom. The freedom to shop the entire mortgage market. If some other lender out there is offering a rate that's way better than your current lender's blended rate, the savings over the long term could easily be more than the one-time cost of that penalty.
And that brings us to the most critical number in this whole equation, the prepayment penalty. This is the price you pay to break free.
So how do they figure this out? Well, your penalty is going to be the higher of two calculations. The first is a simple 3 months interest. The second is something called the interest rate differential, or IRD. The IRD is basically designed to pay the bank back for the interest they're losing, and believe me, it can be a much bigger number.
Let's look at a quick example. Here, the 3 months interest penalty would be $3,000. Simple enough. But because market rates have dropped, the IRD calculation comes out to a whopping $12,000. And since the bank always takes the higher number, your penalty is $12 grand. This is exactly why you have to understand how this is calculated.
But wait, it actually gets even trickier. That penalty you saw on the bank's website last week? Yeah, it might not be the same today. That number is a moving target.
Check out this real-world story from a mortgage expert. A client's penalty was calculated at $8,000. Just 2 weeks later, when it was time to actually close the deal, the bank had changed some of its internal posted rates, and the penalty suddenly jumped to $22,000. You don't get a lock on that number until you formally submit the request to discharge the mortgage. It's crazy.
So, with all of that in mind, let's put these two choices side by side. Let's really figure out which path makes the most sense for you.
Okay, this chart really breaks it down nicely. Porting is probably your best bet if your interest rate is just way lower than what's out there now, and if your penalty is huge. But breaking could actually be the smarter financial play if your penalty is small, or if you can find a rate on the open market that's so good it'll save you more money in the long run, even after paying to get out of your contract.
And honestly, this is the single most important thing to remember.
Don't let fear of a penalty or, some weird loyalty to your bank drive this decision. It's not emotional. It is purely a math problem. You have to run the numbers and do a side-by-side comparison of the total cost of each scenario over the next 5 years.
So, now that you have this knowledge, what are the actual concrete next steps you should be taking as you get ready to sell your home?
There are 3 last really crucial things. First, if your closing dates for selling and buying don't line up perfectly, you might need something called a short-term bridge loan. Second, like we said, getting approved to port is never a sure thing, so start that conversation with your lender early. And finally, get an expert to run the numbers. A mortgage professional can calculate your exact penalty and do that total cost comparison for you.
And that expert analysis, that's something your agent at the Bouma Group can help you get sorted out. Think of them as your main point of contact for your whole move. They can connect you with the right mortgage professionals to build out that data-driven financial plan, making sure you make the absolute most cost-effective decision.
So there you have it. You now understand the 2 main roads you can take with your mortgage when you move. The question isn't, what do I do anymore? It's, which option is going to save me more money? Now it's time to go find out.